The biggest Social Security increase in 40 years. We're going to be joined in the second half of this week's program by our local certified financial fiduciary and national Social Security advisor, Rob Field. Also happens to be one of the members on the team at Nelson Financial Planning. So we're going to get into all of that new information about Social Security in the back half of the program. But we're also going to, at the beginning of the program, talk a little bit about a milestone that we crossed just a few days ago. What that milestone is and what that means for you, we will get into in great detail. So welcome to the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, also named one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel of choice, whether that's Amazon Music, whether that's iTunes, whether that's Spotify, whatever the case may be, we're on it. Just look for Nelson Financial Planning. Get a little lost, go to our website, nelsonfinancialplanning.com, and you'll see some links that get you directly connected to those channels, plus, of course, our YouTube channel. So what's the milestone that we are talking about? Well, we're talking about the single best trading day for the S&P 500 over the course of the past 71 years. That day occurred 13 years ago on a Monday, October 13 of 2008. Let me say that date again. Monday, October 13th, 2008 was the single best trading day as measured by the S&P 500 for the markets in a single day going back over the past 70 odd years. Since 1950, it was a gain of over 11.5% in a single day. Now, for those of you who were following the markets in 2008, you may be sitting there saying, well, wait a minute, 2008, I don't remember that being a good period of time by any stretch of the imagination. I remember the fall of 2008 being a pretty terrible period of time. But see, that's the thing. We talked about this a couple of weeks on the program. Whenever you have these periods of time where the market starts to show a lot of volatility, those good days are also sort of interspersed in amongst those bad days, making it very difficult to kind of predict which way the wind is going to blow in the short term. It's the premise of this notion of volatility loves company, and here we have the perfect example. Obviously, if you remember the fall of 2008, you know that the markets were highly volatile and ultimately reacting to the financial crisis. But there you have it, the single best day ever in the history of the market during, or at least since 1950, occurring right smack in the midst of that. A 13-year anniversary as of October 13th. So when you stop and think about it, the economic, the notion of those types of days really happening and causing people to get distracted, it's easy to do, right? Because if you just think of it going back over the course of the past 18 months, right? I mean, imagine an economy shutting down and some odd virus out of somewhere that winds up infecting people, killing people, all of that. And so you've got a market that's reacting, and maybe you are prone to getting swept up in those headlines. And so consequently, you got out of the market at the worst time. And that's the problem when we see volatility, is it can be very emotionally. And interestingly, when we think about getting out of the market, here's the profile. Male, over age 45, married, who claim to have good investment backgrounds. That's the profile, right? I mean, that's when you study the people that jump out of the market during these tough times, that is the profile. Men married over age 45 that claim to have excellent investment experience. So think about that when you kind of look at this notion of folks jumping out of the market. And I guess here's the other hard part of it. Nearly 30% never get back in. Once you jump out, there's a high likelihood that you won't really find an opportunity to get back in, and ultimately those that got out or get out during panic selling events wind up rarely getting back in. And so when you think of that, and certainly a lot of folks are in that position, what are some of the strategies that you can do to try and overcome this? So we wanted to, one of those things where we always like to kind of talk about a problem, but then provide the solution. So what's the solution? Let's say you jumped out of the market, and the reality is that, it's some of these numbers that you hear can be really pretty dramatic. And I give one more before we kind of get into some of the strategies that we think might be worth investigating, particularly if you have become a victim of panic selling, that you made a decision in the midst of a firestorm to do something to sell out the portfolio. We've got some strategies on that. One other statistic we just want to kind of give you to help give some perspective on it. So since 1930, and this is going to be an interesting one. Since 1930, if you miss the S&P 500's 10 best days each decade, so 10 days per decade, so basically one day a year. If you miss the best 10 days, your total return since 1930 in the markets as measured by the S&P 500 would have been only a cumulative return of 28% since 1930. Add back in those 10 best days per decade, so basically a day per year, and your return goes up to 17,715%. If you don't think it's important to be around for those good days, those numbers should certainly make you think otherwise. The reality is the best course of action is to remain consistent and to not engage in panic selling. However, the reality is that sometimes human nature can take over and people find themselves having done that. So what can you do? Well, the biggest issue is trying to avoid that second mistake and trying to figure out what's the best strategy to get back in. So we're going to take a break. We come back from the break. We're going to set the parameters for some of the strategies to look at if you found yourself victim of a bad decision based upon panic selling in the market. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about some of the strategies that you can use if you find yourself victim of panic selling, because the reality is that if you fit the profile, so it's men over 45 married who believe that they have excellent investment experience. That's the profile, although pretty much everybody does do that panic selling, even though they really shouldn't be doing that panic selling. Maybe you find yourself that you just couldn't resist, and you find yourself looking at it and saying, okay, now what? Because the hard reality is about 30% of the folks that panic sell in the midst of a market decline wind up never getting back in. And if you miss just a handful of those days, then you're going to fundamentally undercut your return. That statistic that we were sharing before the break, going back since 1930, if you miss the 10 best days in each decade, right? So that's basically like one day per year. And there's 250 trading days in a year. So you're not going to have to miss a whole lot. Your return cumulatively, if you miss those 10 best days per decade, since 1930, your cumulative return is only 28%. If you had remained invested through all of it, including achieving those 10 best days, along with all the other bad days, The importance of being consistent, your return 17,715% cumulatively over that period of time. So pretty dramatic. All right, so now what do? You find yourself, okay, fine, I overreacted. Maybe I overreacted to, like this pandemic thing, whatever the case may be, and you find yourself not in the market, you're out of the market. So what are the strategies that we can do? So the biggest issue, of course, is you don't want to compound your mistake, right? If you get back in and then all of a sudden the market goes down 10% or 15% or 20%, then literally you sold low, you bought in, and then it went lower. You've just compounded the mistake. So those are the kinds of things that you want to try and avoid. How do you do that? I think the best strategy is thinking about it from how do you invest best in the first place anyway, and that is over time, and that is the process called dollar cost averaging. So if you're putting money in on a regular basis, so let's say you get out of the market, your portfolio's got $100,000 in it, and you're like, okay, well, how do I get back in? Take $5,000 a month. Take $5,000 a month and systematically exchange it back in to the investment allocation that you had, or maybe you need to tweak the investment allocation you had. The reality is that you need to get out of the cash position. The way that you can do it is to do it on a gradual monthly basis. Same kind of philosophy you could use if you have cash. Maybe you didn't panic sell. Maybe you've just got cash because you sold a property, or you sold a business, or you just have some cash, and you're trying to figure out, okay, well, how do I get that invested back into the market? Because right now, particularly this past week, the market went on to set higher highs. Well, one of the things that you can do, again, take advantage of the concept of dollar cost averaging, putting a little bit of money in each and every month. Kind of set a timetable for that. Like over the next 12 months or over the next 18 months, I want to see that all of this money is getting invested. And ultimately, by doing that systematically each and every month, you really do help to smooth out the potential volatility in the market. Another way to really accelerate that or light some fire to that strategy is if the market does go down, then you would accelerate how the time frame in which you're putting money back into the market. So let's say you're doing 5% per month, and you do that for 6 months, and then all of a sudden the market dips down by 15%. Maybe you try and front load the next 6 months at that point in time because of what's going on in the market. So those are kind of the strategies to be thinking about if you find yourself outside of the market looking in. Or maybe you didn't panic sell. Maybe you're one of those folks that's sitting on a lot of cash and saying, okay, how do I get this back in the market? Or how do I get this into the market for the first time ever? What's the best strategy for it? So those are some things to remember. Dollar cost averaging, and then meaning putting money in on a systematic basis, and then to the extent that there is a market decline, then you would say, okay, I'm going to accelerate those monthly exchanges, those monthly investments, to all more of them occur during that period of time where you would see a market pullback. So that would be certainly the strategy for folks that got out of the market, whether by panic selling or, as is the case just as much, is there's a lot of cash sitting out there, people trying to figure out what to do with it and how to do with it. So think about those strategies, particularly if you're looking at your checking account and looking like, I made 2 cents on my money that is sitting in cash. That may be an opportunity to kind of do something differently with it. Speaking of finances, one of the things about anything financially related is the notion of having a goal. Studies show that if you have a goal, then of course you are far more likely to accomplish it, right? Makes sense. I think there's an expression, or maybe it's a book that talks about begin with the end in mind. So when it comes to some of the personal financial goals that people need to think about, we wanted to spend the rest of this segment sort of talking about some of those bigger ones, because the reality is that if you set a goal, then you are far more likely to achieve that. You don't set any goals, then maybe you get there, maybe you don't. So we're going to talk about some of the specific goals that people need to set financially in order to increase their chances of achieving them in the first place, right? So what are some? This list is in no particular order. First might be having an emergency fund. I mean, one of the things about having an emergency fund is that an emergency fund is a foundation of an entire effective financial plan, right? That is just having some money on hand that covers 3 months, 6 months, 12 months, whatever the case may be, but there's cash readily available that's not subject to any accessibility limitations or any fluctuation. Those are the things to be looking at in terms of having that emergency fund, because the reality is that it really is a backstop of if you need some money, it is there. Sort of like insurance, right? You hope you never have to put the claim in. You hope you have to never use the emergency fund. But again, that is what it's there for. So set the goal of, hey, I want to have an emergency savings fund of 6 months. Because if you don't set the goal, then your likelihood of achieving it is pretty low. Same thing for education, right? Whether it's educating yourself, whether it's educating kids, grandkids, those kinds of things, it's important to kind of set a goal for that. There's great options in terms of saving money specifically for education, whether that's a prepaid savings plan or a prepaid plan or a savings plan. Both of them are different in terms of how they function, but the reality is that they wind up being great resources to use for educational purposes. And don't forget about yourself. Maybe there's some additional career training or education that you need to do as well, even after college. So important to kind of have that as a goal as well. Retirement savings, right? Of course you need that as a financial goal. The sooner you start on that, of course, the better off you'll be. If you're starting sooner rather than later, it's obviously the power of compounding, the notion of time in the market, not timing, is the best way to achieve results. And so some of the other things that you would say, okay, I got to set a goal for in order to achieve this. Let's say you want to get married, right? The average cost that a couple spends on a wedding and a reception these days is $28,000. So that's a lot. So rather than go into debt for it, you may want to set the goal of, hey, we're going to try and get some money together for that wedding. $28,000, shoot, that's as much as a car, right? I mean, that's like the next thing, right? Car, probably more of a necessity these days. Average American household has almost 2 cars in it. Another great goal to have is to get out of debt and stay out of debt, more importantly, because debt, of course, is a big financial drag. Once you're out of debt, it frees up cash flow that you can use for other purposes. So one great goal to start with is this notion of getting out of debt. Probably that combined with starting an emergency savings account. Those two would be goals to have initially if you're just sort of starting out, if you will. But maybe you're further along, buying a house, having a down payment. Obviously, 20% down is a great way to avoid the PMI, or the private mortgage insurance that comes with it. So those are just some of the many things out there to set goals for. We wanted to kind of just talk a little bit about that, because the reality is that if you set a goal, you are more likely to achieve that. So important to know some of the things that you can set goals for from a financial perspective. All right, coming up next, without further ado, we got a lot to talk about when it comes to Social Security. So our fellow certified financial fiduciary at Nelson Financial Planning, Rob Field, is going to join us in this next segment to talk about that. Coming up next here on Dollars and Cents. All right, the biggest pay increase for Social Security recipients in 40 years. We're joined with us in this segment with our fellow associate and certified financial fiduciary at Nelson Financial Planning, Rob Field. Welcome back to the program, Rob.
It's good to be back. I always enjoy being on the show.
Well, you got some interesting news to report for us today.
I'm lucky I get to share some numbers that are exciting and people have been looking forward to. We're every year about this time, Social Security will start announcing what the numbers are going to be for next year. Cost of living, how much your income would be taxed, how much money can you make, and not have Social Security be reduced from your income. So the first and foremost, and this has been in play and rumors have been going around, and we even talked about it a few weeks back, is a cost of living adjustment on Social Security. And so starting in 2022, it's going to increase by 5.9, almost 6%. So the monthly income of individuals who are on Social Security going into 2022, they will see a bump up of 5.9%. That equates to about a $92 average per month. Not huge, but we're heading the right direction. Or for a couple who are both on Social Security, you would see about $154 per month increase. That's, it's kind of that good news, bad news.
Right.
6% it sounds great, but it's truly not a bonus in the fact that we're still trying to get the elderly caught up. Seniors are still, they probably see inflation in the items that they buy and that they're involved with going up faster than the average person. So
certainly with healthcare being a large expense, right?
Correct.
I mean, in healthcare, so think about the cost of living adjustments that have been applied on Social Security over the past 10 years. It's been pretty dismal. I think the average cost of living adjustment has been like around 1.6, 1.7%.
that is correct.
Last year it was 1.3. 1.3. I mean,
Right.
so these have been minor adjustments that we've seen over the course of the past decade. I think 2016 it was nothing. It was zero.
Correct.
Right.
That's only 5 years ago.
Right.
And we know inflation has been growing not at zero.
Well, and here's the thing, certainly you're hearing a lot of it, and it's a very popular topic to be talking about right now. Oh, I get a 6% increase, and that's great. But the reality is that that's really not great, because that's not extra money for somebody. If I say to you, I'm going to give you 6% more, that sounds like that means that you're getting more money in your pocket to do more stuff with, but you're really not.
That's correct. Social Security's goal was not to give people a bonus, but is to try to keep up with inflation.
Right.
So they have realized that over the years, including if there's nothing happened in 2016, they know they're behind. So the pressure was on to get seniors back up to a level where their spending can be more comfortable. So the 6% is wonderful. That's a nice step, but they base it every year on the Consumer Price Index for workers. And that index is really just the average worker and what do they see the average person have an increase in the items they buy, the clothes, toilet paper, things like that. Seniors have a tendency are seeing greater inflation or faster inflation on the items they buy because they've got prescription drugs, which are growing very quickly inflation-wise. Assisted care is something that the average worker doesn't have to see. Assisted care is higher for a senior. In-care home, out if the premiums they're paying for Medicare are going up also, and so we're trying to really just get them caught up. It's not really going to be a bonus. You're correct.
Well, and it's funny because my wife and I were having this conversation during the course of the week, and she asked the question of, well, is it political? I mean, is this something that that the current administration is doing to make themselves look good? And the answer is it's really not, because the COLA adjustment for Social Security is set on some objective data based upon the economic CPI indicators. I mean, it's
Correct.
This is not like part of like some legislation or something like that passed in Washington. It is a established COLA, cost of living adjustment, that simply looks at the economic data.
Right. It looks at the Consumer Price Index for the worker, which is where they come up with their numbers. But there's another index that is being pushed, and I hope they'll use it, and there's actually a CPI for elders, for the elderly. And it looks at their basket of goods, their items that they're purchasing, clothes, food, medical supplies, things like that. That number is growing faster just because the cost of living.
And has been for years.
And has been for years.
Right.
So if they would shift over to a CPIE for the elderly, I think it would be more accurate. It's in the talks, and so I hope it does.
Well, it's in the talks, but here we are. You got Washington all talking about tax credits this, tax credits that, and we hear about the child tax credit and how that was expanded. Another one of our fellow certified financial fiduciaries and CPAs, Kristen Cayley, was on the program here a couple weeks ago. We're talking a little bit about that expanded child tax credit and how that's literally generating out checks to families with children. And a lot of folks, a lot of seniors have said, well, that's all fine and dandy that you're giving checks, okay. The reality is that those folks still have their earnings years in front of them.
Correct.
if I'm 80, where is my senior tax credit? Here we are passing all this legislation to put money in the hands of people that can still work, and the senior population is barely staying ahead. I mean, at 80, you're not going to run out and get another job. At 40, in theory, you know what, you could, and you probably got enough gas in the tank to be able to do that. So just, when you stop and think about it, this is one of those good news, but not really good news.
Correct.
On this 5.9% adjustment.
Right. I mean, last year was 1.3. Everybody thought that was way too low. Yeah. So as we moved along to this year, there was a fear that what if it's only another 2%? Which, yes, that's an increase, but we're not keeping up with inflation. And the elderly are living longer. I mean, with modern medicine, people are living farther and farther in. Like you say, they're not working, so they're pretty much. We talked about this before. 1 out of 2 seniors, 50% of their income comes from Social Security. Yeah. 1 out of 4, 25% of the people on Social Security, 90% of their income is coming from Social Security.
Yeah, and that's a pretty staggering statistic.
Right.
I mean, you think about, again, not to belabor this commentary on Washington, but I think it's pretty well known. I mean, the real issue is Social Security is projected to, and everybody says, run out of money, and I think that's a little sensationalized, but the reality is it's by the year, I think it's now 2033
is the latest number. And again, they look at what's going on today, and then of course some of the changes we talked about was the cost of living. The amount of tax they put on people's earnings is going up. Used to be 142,800 last year, or for the year we're in. Next year they're going to tax up to 147, so that'll pull in a little bit more money, because that's where a lot of Social Security's money comes from that they use to pay out the benefits. They are sitting on about 2.85 trillion of government bonds, and they use that to help supplement. And because of COVID in the last couple of years, they paid out a little bit more than they've brought in. And so that scares people. They're like, oh, well, what's the effect? Again, if they stayed the way they are now, never made a change, 2023, the reserves would end, but we would still have employees earning money. At that point, if we had no reserves, and that's not going to occur, but if it did, you would have maybe a 25% decrease, or 75% of what people are currently
so the program itself could only afford to pay 75% of the benefits that it has promised. And based upon where things are today, if nothing changes, then it's 75%. But 2035 isn't that far away.
No.
I mean, that's not that far away. And yet we have a government that, I mean, you want the list of problems, and I understand, we're all, talking about all the other climate change and this and that and all that, but we got a real problem here with Social Security that is being ignored, and the clock is running.
Agreed.
Anyway, we're going to take a break. When we come back from the break, we're going to continue the conversation here about some of these Social Security changes for 2022, a good news, bad news story at the end of the day when we return here on Nelson Dollars and Cents with Nelson Financial Planning. So good news, bad news as it relates to this Social Security increase, this COLA adjustment at 5.9%, biggest in how many years?
40 years.
40 years. So that's a good long period of time. Of course, if I go back into my history books and I think back to why the COLA adjustment on Social Security was higher than 5.9% 40 years ago, that wasn't exactly a particularly good time.
Well, we had interest rates were 18% in some levels. Inflation was extremely high and out of control. And again, so some of those numbers, as you and I've talked about, 14.3 in 1980, that was
right.
The increase. And you would think, well, gosh, that would be phenomenal. But inflation was going so quickly.
At 18%,
it was simply
right.
just trying to keep up with it.
At 14, it's all gone. And that was in 1980.
Right.
So in 81, it was 11. So it went from 14.3 in 1980 to 11.2 in 81, finally coming down to 7.4 in 1982. And since 1982, it has not gotten close to that, this year being the closest in that 40-year time span.
Right. This is a huge, it's that good news, bad news. 5.9 is huge compared to what we've seen. 5.9 is not enough compared to where we are, especially on the senior level.
It doesn't buy you anything more. The reality is a cost of living adjustment simply repairs the purchasing power of those dollars.
And we can make the argument that even at 5.9, it's not really catching you up. It's just a bigger step.
Correct, because as you were saying in the last segment, there's clearly a different inflation rate that applies to seniors versus the population at large.
Correct. It's a whole different basket of items that they spend their money on that cost a whole lot more than the average person.
And particularly, the real impact is the 1 in 4 that count on Social Security for at least 90% of their income.
Right.
That's some pretty significant numbers. There were some other things that adjusted. You talked a little bit about one of them in the prior segment. That's the wage cap. So
Correct.
When you pay Social Security, you only pay Social Security up to a certain amount of wages. That increases for 2022 up to, what was the number again?
147,000.
Okay, so now you've got to pay more of your wage, Social Security on a higher amount of the wage. But there's also another piece that sort of changed too, and that's the earnings limitation. What was the numbers there?
Correct. Social Security tells you that if you're collecting Social Security and you're under full retirement age, there's a point where they'll let you make a certain amount of money. And so the first number that we're going to hit would be if you are under full retirement age. That's somewhere between 66 and 67, between when you were born. You can earn up to $19,560 and have no reduction. Your Social Security. So you start at 62, you're up to 66 and a half, you're in great shape. If your outside income, this would be other than the Social Security, goes above that 19,560 number, they'll start holding back $1 for every 2 above it.
And that's an increase over last year. Last year was 18,960. Now it's increased to 19,560.
Right.
So that's good, and that's the earnings limitation. So it just looks at work. It doesn't look at retirement or pension or rental or investment or anything like that.
Correct.
It's just work income. That's the important thing to be thinking about. That earnings limitation kicks in if you take it starting at 62 right on up to your full retirement age. I know there's a different rule.
Correct.
If you're in the year in which you turn your full retirement, but yes, it's more, but I just part of me it doesn't like the notion of having that earnings limit in the first place, right? Because if I want to work and collect the money that I've paid in, to be penalized like that, I mean, you could certainly make the argument of, hey, why not let people work as much as they can if they choose to take Social Security early, but at least that gives them the opportunity to work. But that's not how it works. You've got to watch that earnings limit.
Unfortunately not, and I agree with you. I mean, you never want to penalize somebody for trying to work and help themselves. If you know Social Security is only a small piece possibly of your income, why would you then want to limit how much they could make outside? But they do, as you did mention, was throw out the one more number. If the year you turn, that you're going to turn full retirement age. So if you turn 67 in July, then the beginning of that year you could earn up to 51,960 and not have a reduction. If you cross that number in that time period, they'll start holding out $1 for every 3. And when you hit full retirement age, whether it's 66 in 10 months or 67, which is the new number if you're born 1960 or beyond, you can earn whatever you would like and not have a reduction. And that's great.
Yeah. So now there's one other piece that has not yet come out, and that is how much your new Medicare Part B premium is going to be.
Correct. Part A is already built into it. Part B is something you're going to pay out of pocket. Again, you start talking about Medicare. Now we're at the senior level of people paying for medical insurance. Their costs are higher. It's going to go up $10, $12 a month. So again, that 5.9 sounds great. Now that's reduced because the cost of Part B will go up.
The average increase per person of $92. Okay, there goes 12.
Correct.
Okay, just on Medicare.
Right.
And they usually announce that in another few weeks. So we'll obviously let folks know what that increase is going to be. But I mean, yeah, I mean, I got an extra $92 to help pay for stuff that's all costing me $92 more than it was anyway.
Right.
But then I lose 12 on Medicare. It is tough. But I mean, at the end of the day, the bottom line is, you folks need to also make sure that they are saving beyond just relying on Social Security.
It's so important that you view Social Security as one of this magical financial stool we talk about. Social Security is a piece. It's a great piece in the fact that you do know how much you're going to get every month, not going to fluctuate. So it gives you a little bit of stability. But you have a retirement plan, or you have access to a retirement plan at work, that if you contribute to that and get some matching, that can be a big part of your income. And then just your outside income. What do you have in your checking account? What do you have in your savings? And so we encourage everybody to coordinate the three together and utilize Social Security the best you can. And we have ideas on when to claim and how to do and how to work with your spouse.
You run projections and stuff like that when folks want to kind of have some detailed answers on that.
But you've got to utilize your retirement plan. Anybody has a 401k and is not getting the full matching is right off the bat holding themselves back a little bit.
Because one of the things that folks should conclude just after listening to these segments about Social Security and COLA and how there's a high rate of inflation for seniors is Social Security is not going to be, it's barely sufficient anyway. It's certainly not going to be sufficient. The need to have additional savings is paramount at the end of the day.
I mean, when Social Security came out in the 30s, they did not say this is going to take care of you completely. They said this is a supplement. You paid in, we're going to help, but look for your other. They've always wanted you to look at other resources, if possible.
Yeah, and that starts early and just saving a little bit of money each and every month, along the same lines of what we were talking about earlier in the program, the notion of dollar cost averaging. For those folks that are nervous about investing or don't really understand it, just putting a little bit of money away each and every month is a great way to get to learn how to save and invest, and also to help smooth out the volatility in the market.
Certainly. And if you considered maybe Social Security sort of your safer investment and you had the stability of that income coming in, you could really utilize a dollar cost averaging into some equities, some stocks, mutual funds that are designed for growth. Because you got to save the money and you got to get it to grow. As you mentioned earlier, you miss some of the potential growth opportunities in the market. You really cost yourself some returns down the road. No,
that is for sure. Well, certainly some interesting numbers as it relates to Social Security and the changes. So the 5.9% is the big headline. Also more wages susceptible to the Social Security tax, and then a little bit higher earnings limit if you're taking it early. So some interesting stuff. Thank you for joining us and updating us on all the latest and greatest for Social Security.
My pleasure. Do it again soon.
Very good. And thank you all for listening to the program. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning. Have a great rest of your weekend.